Ryan Selkis is the founder and CEO of Messari. In 2021, he managed to predict absolutely every single hot crypto trend from NFTs to DeFi. We now have him on the show to tell us exactly what he thinks is going to happen in 2022. Please enjoy. Do you think it's a realistic goal for someone to try build their network and value add in the space to the position at this point where they can get access to this network and those sorts of opportunities? Or do you think it's low ROI on time type of play?
I think the only way that you really do that is if you're building, right? So I think the bigger value add and the bigger economic opportunity for most people that are getting in is just to either contribute to or build startups, right? And there's so many companies that are hiring right now. If you want to develop a reputation and network, just join somewhere and kind of get into the trenches. It's going to be the fastest way to learn. You're going to get paid to learn. You're going to get paid to build your network, depending on what the role is. So I think, and for 99% of people, the path to, actually doing well financially within crypto is going to be by increasing your earnings power, not by riding a massive bull market to another 100x, right? The folks that made 100x were in last year. You can't kind of go back in time to the beginning of the cycle. And it is overly optimistic to assume that trend is going to persist, right? We'll have another bust. We'll have maybe several other busts. Things will cool down, and then it'll be more interesting to get kind of full-time into kind of deploying capital in different liquid markets. But your guess is as good as mine for when that actually happens.
Let's dive into the 2022 thesis. One of my favorite things in the entire thing was your top 10 list, as I'm sure it is for a lot of people. It doesn't matter if you're a beginner or advanced. Ryan, I don't know how you do it, but you write it in a way where you don't overcomplicate anything. I could give this paper to anyone, someone who's completely new to crypto, maybe a little bit of basic understanding, or someone who's very advanced in the space, and it's going to be hugely beneficial, whoever you are. So in your top 10 list, the first 3 points you made kind of had this overarching theme of moving towards user-owned economies. Your first one being increased distrust, increased institutional distrust. Now, practically, what sort of signals should we be on the lookout for that will further accentuate and bring more people in crypto, in terms of like what signals that confirm this narrative that distrust is growing and we really are moving in that direction?
Well, I don't think you have to look far or too hard. I think this has been something that's been building for a long time in the West in particular, right? This distrust in institutions. And the graphic that I point to in the report is from a survey that Edelman had run, and basically showed that on two axes, competence and ethics, no modern institution ranks in the upper right quadrant that's both ethical and competent. You have businesses that are viewed as competent, but maybe slightly below the axis in terms of ethical. You have NGOs that are viewed as ethical, but maybe not as competent. And then you've got like media and government that are neither competent nor ethical. And like government and media score, in that kind of dreaded like lower left quadrant. I think, market-based solutions and software, because it is apolitical and it's automated, those systems could conceivably replace trusted institutions, because I think more people will trust math and code over time, especially math and code that comes with tokens which can coordinate and align incentives. I think the big opportunity that people have identified, really talented people are getting excited about Web3, it's that the design space is wide open, and we've kind of gone from 0 to 1 already in de-risking crypto as an asset class and as a technical movement, right? So I think it is intuitive to people that owning the networks that you participate in is a better model than basically being rented out by Facebook or the big tech companies, or basically being the rent that's extracted by Wall Street every single time you do a financial transaction. I think those things kind of resonate with people in general. And after they get past like the volatility of the underlying assets and just the word crypto, right? So I think most of the talent that's coming into the space right now, in design, in like professional finance, in like Web2 tech, people that are really kind of at the bleeding edge that have had their eyes kind of open to the opportunity set. That's I think that's what attracts them. It's could we basically build a better internet and better marketplace infrastructure so that the world is a little bit flatter and people actually own the services they use and the kind of future of the economy is a little bit more democratic and user owned instead of institutional owned. Now the criticism there is, well, are the new rulers going to be the same as the old, just with more of like a tech bro tint, right?
Why are you asking my questions for me, Ryan? This is my job. Where I'd move on to next, and you did touch on this, was with regards to companies like Facebook and Meta coming into the space. Like, we've got a very loyal and big crypto community, and you said one of the most important things is for us to push our values forward and do this thing right, per se. But how can this community compete when the existing giants try to come in, like Meta? Like, what power does this community have compared to Goliath like that?
I think institutional inertia is, throughout corporate history, it's and history in general, it's very difficult to pivot an entire business, and particularly one where you're going to cannibalize your own revenue. So this is like the innovator's dilemma, and what's his name from Harvard? I'm blanking on his name. Christensen. I don't know why the name is eluding me right now. I'm tired. It's been a long year. But the Clayton Christensen. I think the general theme of startups is, if an incumbent can beat you at your own game, you don't have a really compelling business. And what I think about with Web3 as an unfair advantage is they are starting with a complete polar opposite approach to the Web2 incumbents. And that is, we are going to make every single one of our users, especially our early users, owners in these networks. So you're basically encouraging early users to defect from the legacy platforms, and you're giving them real financial incentives to do so, and not only real financial incentives like $10, but like multi-level marketing incentives where we're going to give you $10 today, but if you help us grow this network and invite your friends, that $10 could become $100, $1,000, $10,000, $100,000 because you were here early and you basically helped us siphon all the demand away from the Web2 incumbents. And now as we find that business model, whether it's token-based or ad-based or whatever, the rewards are going to get distributed to the user base. And essentially the stockholders of Facebook, which were like the venture capitalists and the principal investors in the private markets, now they become the end users of a given network. And I think you're still going to see we're already starting to see like crypto funds like play in those liquid markets. But it is different because there's an entire pool of capital that's going to go to users and employees that historically went predominantly to the investors and maybe a little bit to the employees. And so you're basically kind of turning the value sharing pyramid on its head, where it's users first, contributors second, and then the kind of speculative investors third. And going back to my kind of former comment, the speculative investor is not going to be passive, right? So they're very frequently going to be like some combination of like user and contributor. It's such a stark change in the approach to building a business, and you are incentivizing like a narrow wedge of users that Facebook is never going to go full Web3 before a Web3 native social media play because most of their revenue is still derived from suburban moms that are 40 to 60 years old. That is not the early stage demographic for Web3. Like they are not going to grasp that regardless of whether Facebook rolls out that solution or not. They're going to be a little bit later to adopt those solutions, just statistically, right? We know that from the demographics that we already see within crypto. So I think even if these big incumbents want to go where the puck is moving, it's going to be extremely difficult for them to do so. Ironically, Meta is probably one of the platforms with the biggest opportunity because they can take this piecemeal approach and kind of disrupt themselves gradually. You could start maybe with Oculus, right? And WhatsApp and Messenger, these platforms that haven't really been monetized yet already. And then like the Blue app, Facebook proper, is maybe the last to adopt and to adapt here. And Instagram, maybe the last to adopt and adapt. And I saw a good quote from I think it was Matt Wong from Paradigm. Wrote something about the kind of digitally native social networks versus the real life social networks, right? So you think about like Facebook, it's sharing your real life updates. Instagram, it's sharing your real life pictures, versus like Twitter, it's like all of your virtual communities. Reddit, it's like an entire virtual community. And I think there's something real there. And what's interesting about Meta is you kind of have the same split within their products where like it kind of goes back to what I said. Facebook doesn't need to be disrupted and go Web3. Instagram doesn't necessarily need to be disrupted and go Web3 because those advertising models will work. And I don't know that their end users are necessarily Web3 natives. Oculus, like there's literally people living in the fucking metaverse. So if Meta is going to build the hardware to actually make the metaverse and like AR and VR more real for more users, and they're predominantly going to be younger users to start, that's a perfect place to embed like Web3 type incentives. I think I think Zuckerberg is a genius. People will debate like whether he's a good corporate leader or whatnot. I don't think you can argue with his success and his kind of vision and ability to execute. Just if you look at how he's done with M&A, but I think because he is insanely intelligent and ambitious, the smart play with Oculus, for instance, and the VR play is to embed user incentives from day one. Because if Oculus just becomes this like dystopian, like Wall-E type of like corporate sponsored, ads only like world, and it looks like an amusement park for like corporate greed, no one is going to play in that like virtual amusement park. They're going to go someplace where it's more wide open. It feels more like the frontier. They don't feel like they're being like monetized and sold to. So I think just from a viability standpoint, Facebook will be able to make money from the hardware and become more like Apple, right, as they continue to scale Oculus. So that's one revenue stream. And then do you want to build a platform that's more like iOS or Android? And I think that will be the more interesting decision to see which direction Facebook goes. Because if they go, there's pros and cons to both, right? If they go I actually think a hybrid would be best, because if they go Android, then they're basically saying, okay, we're going to try to lean into our ad-based business model. If they go iOS, they're saying we're going to take these large rents. And really, the answer might be somewhere in between, where it's like an Android-like open platform, but we're only going to monetize it on like an opt-in basis or by selling other virtual goods. So it's almost like they opt out. They create the same type of marketplace and platform, but they go more towards how like the gaming giants did the last like 5 to 10 years, which is they lean into the sale of virtual goods, NFTs, like, iOS level opt-in marketplaces where you can kind of go through the Oculus store, and these are like the curated, vetted third-party apps and places to go and people to see. And in return, probably not 30%, but we'll take 10%. And I think users all day long will opt in for that type of model. So the pie that they can potentially eat from is orders of magnitude bigger than if they pick it up and they try to create this like ad-driven experience.
Ryan, Facebook should hire you to restructure.
Yeah, that's one area that I don't think startups can compete. Like startups cannot deploy $10 billion a year into hardware investments, like full stop. So you want and almost like need Facebook to emerge as one of those key players. And then like the software is where I think people will compete, but not necessarily the graphics or like the development of the hardware infrastructure needed to power those worlds.
That's the best answer I've heard to that without contest. Can't tell you how much I appreciate you on Ryan. You also mentioned the very compelling argument of like there's this new paradigm where the user-owned economies, like it's so much incentive to move away from the existing giants that it becomes hard to value this or even fathom like how much this stuff should be worth. And something I'm noticing and seeing right now, which goes into your point on venture capital in the thesis as well, is that valuations are getting insane. Companies with just an idea and no product are raising at 500 mil plus valuations right now. I mean, it feels like a top signal, but is there any argument against this being a top signal? Could it be that things are just valued more now because users can have ownership of them, and this is just the new stage of the world in companies?
I think the thing that everybody misses about crypto valuations right now in the private markets is that the time to liquidity is extremely compressed. So first of all, if you think about like a blockchain infrastructure company or an exchange, those services are making tremendous amounts of money, right? Like 9 figures to $1 billion a year in either like staking rewards or transaction volumes, just because of like how much activity is ongoing. So like there are infrastructure companies that are raising at like eye-popping totals, Fireblocks, Anchorage, Blockdaemon, Bison Trail is a big acquisition from Coinbase. I think those businesses all make sense. And they're making a ton of like revenue by providing like picks and shovels to this economy. Then there's the token plays, and you talk about like a seed stage startup, like a gaming company raising like 500, like at a $500 million valuation. That's insane if you're holding for like 7 years and your time to liquidity is going to be like 7 years, because you're just taking so much idiosyncratic risk along with market risk and the fact that things could cool off next year. But if the time to liquidity and the time to actually distribute these rewards, even if they unlock over like a 36-month period or whatever, so you're still taking some timing risk, that there's a not insignificant chance that investment could be marked up 3x in maybe 6 months. So even if you can only take a third off the table if you want to for like capital planning purposes, and kind of risk management purposes, then that you basically get paid back, and now you're playing with like a free lottery ticket. So I think people often lose sight of the fact that because these are liquid markets very quickly after they're illiquid markets, you can juice valuations when the public comps within crypto are sky high. There's two ways to value companies, right? There's like the fundamental, like historical discounted cash flow type analysis, and then there's comps. And most of tech trades on a comps basis because you're basically looking at the 5-year, the 10-year earnings potential and value creation potential, not necessarily like where the company is today. And you're basically just making projections about growth and potential market sizing. So I think if you look on a comps basis plus time to liquidity, that's how you can get to these numbers. I personally don't invest at that stage because for a few different reasons. I like I said, I'm more patient and can go earlier stage, number one, and number two, I just it creates, I think, some personal conflicts if I start to get into flipping tokens while running like an information business that could potentially cover those tokens as well. So it just makes my life easier to buy and hold.
Do you think there are, say, someone who has no sort of informational company or association with the public, just a venture firm that's working on the back end, raising money at that 500 mil valuation for just an idea where fundamentally it becomes, you can only really justify it through the public's demand to just buy it with the same hopes of flipping it for higher. Is there any issue with companies continually just raising these valuations purely based on demand and raising more and more money?
I mean, I don't think that there's any issue. I mean, you take the money while it's there, especially if it's if you're not diluting yourself too much. But for early stage companies, you can create some kind of wacky incentives if you raise too much too early, because now the expectations for you to actually realize some like liquidity event or like some value creating event for your team and your investors, like the stakes are much higher, because you just need to grow into a valuation that the public markets or some acquirer will be able to support. That's a high class problem to have, but I don't think it's a complete non-issue if the market turns, right? So again, I think founders is the same calculus. Are you going to be coming to market relatively soon with a token, for instance? And again, do you think that these kind of valuations are fair and sustainable? Because I don't think that the kind of late stage private market investors are stupid. That they're taking maybe a rosy look on the future of Web3 over the course of the next 5 to 10 years. But again, many of the companies that are getting these really eye-popping valuations, they have real hockey stick metrics and real value extraction like business models that investors think are sustainable. So I think that's the same calculus is true as a founder as is for a venture capitalist.
I know that's a touchy topic. Thank you for the answer. Ryan, I know your time is valuable, so we're moving on to the last section covering how high we can fly and the coming crypto winter. One of the quotes you mentioned, which I absolutely love, was the time to go all in with crypto on your balance sheet was last year. I'd be more cautious here, 10-year and 10-hour thinking only. To put this into like something tangible, could you give us an example of one good 10-year play and one good 10-hour play? Even if you don't want to give a current one, an example of previous ones, just so people can perhaps replicate that same framework.
Yeah, I mean, I think Bitcoin and Ethereum are the 10-year plays, right? 10-hour plays. Like I said, I'm not a day trader, but I guess my point there is I wouldn't be married to any position whatsoever, whether it's in DeFi, whether it's in NFTs, another layer one platform. I just think, the market could go either direction right now, and what goes up must come down, or what goes up and what gets realized must get sold to pay for taxes is maybe the other way to look at it. So like you are going to have some selling pressure from people that are taking gains and paying taxes or paying distributions if you're talking about the investment funds. And I think, the question is, will the incremental new investors be enough to offset that? And it seems like we're kind of like in this like temporary battle between bids and asks. And it's essentially just like a rotation of capital to a new set of buyers and holders. So I don't think it's necessarily bearish, but it's not like we're just on this continued parabolic move north. And I don't think that there's anything that's like a screaming bargain right now within crypto. I'll put it that way. Could we go higher? Yes. Could we go lower? Yes. So think about where you expect the industry to be in 10 years and kind of what your long-term thesis is first and foremost. And then I would say for most people, it's not, thinking through which speculative investments you might be able to make, but again, like where might you be able to build and like where might you be able to add value as a full-time participant, because getting into crypto full-time as a career is a better path to value creation and extraction than just trying to play the ponies and out-trade some of the professionals.
Definitely when it comes to trading, I think it's way easier, more rewarding, and better, higher probability of success becoming a builder than a day trader. But for those in other industries, passive investing with a long-term vision, with managed risk, is a great approach as well. And for the longest time, I've been using, like you said, Bitcoin and Ethereum and treating that as almost an index basket of the whole market because it covers such a large proportion of the market. But you've mentioned how crypto really is decoupling. For how much longer is that going to stay the play that gives you exposure to the entire market? Are there arguments even now that it doesn't give you complete exposure to the whole market anymore, and there are other places you need to look for getting that index all-encompassing exposure?
I don't really know of a better index play right now. And the problem is that the constituents of like any index will change. If you're talking about like the top 10, do you really want to own the top 10 right now? Probably not. Do you want to own all the layer ones? Maybe, right? Do you want to own a basket of all of the DeFi blue chips? Maybe. So, I think we're going to start to see more of those. And I think the market will kind of satisfy that demand. But, where things go, in terms of like performance, outperformance, underperformance with just Bitcoin and Ethereum proper, it is hard for me to envision a scenario in the medium term where if crypto succeeds, those don't do very well. I'll put it that way. And likewise, if crypto faces a winter, those will likely be the two most resilient assets. And then you kind of reset expectations and kind of figure out what's actually built to last. Amidst the wreckage, and we kind of go through maybe a smaller version of what we saw in 2018 and 2019 in terms of like finding hidden gems and teams that were actually continuing to build and continue to iterate them in the right direction. But we're still a ways away from that. And like I said, I think that the addressable universe of projects that are going to be long-term interesting to professional investors. Even during a dip, it's probably 2 orders of magnitude broader than it was after the 2018 bear market.
It'll rhyme, but I doubt it'll repeat exactly the same. Ryan, I can hear the screaming kids in the background. I'm definitely going to let you go. Final question of this podcast. Ryan, this is one I'm personally curious about, and I know because you're all in on Mizari, which everyone needs to check out. You may not even have investments outside of crypto, but is there anywhere you look to outside of crypto? Is diversification of just your assets? Because even if you're all in on Mizari, you're going to have assets that you need to put somewhere. Do you ever look outside of crypto?
Not at this point, except for real estate and cash. So those are the 3 assets that are of interest to me. I don't really see the marginal value of a stock portfolio. If the bubble pops in the low interest rate environment, then growth stocks are going to suck wind, and we're going to have a period where things go flat or slightly negative. So in that environment, I also think that crypto likely corrects. But there will be much more early stage opportunity, and my personal mix will just kind of go to emerging projects and emerging teams that have caught lightning in a bottle and are solving real kind of pain points for the industry. So it probably goes, the most conservative would be if we had a blow off top and I moved, a good chunk of my assets to cash, on a temporary basis, just to kind of de-risk a little bit and yes, you're kind of combating inflation, but at the end of the day, if things get really wild, you might be perfectly happy sitting in cash for a little bit just to kind of see which direction the market goes. So not investment advice, of course, but how I'm just thinking about my personal book.
If you enjoyed that, make sure to head over to the official Market Meditations channel to get access to the whole episode.